All right, so let's get started. So welcome everyone. Thank you so much for joining us today. That's our closing session on the COVID-19 series of webinars that is being promoted by the Department PUC-Rio. And today you have the great pleasure of having Marcio Garcia and Professor Baeey Eichengreen from UC Berkeley to join us on this conversation. And we're going to exploit many topics around the macroeconomics of the pandemic. And we're going to follow a different format today. So Marcio will point some issues to be discussed by Professor Eichengreen. And then we'll have after a series of interactions, we'll have questions in the end, unless you guys send some questions to the chat, and then we'll try to incorporate them over the discussion here. So thanks once more, Professor Eichengreen and Marcio. It's a pleasure to have you here. So Marcio, over to you.
Thank you very much, Juliano. It's a great pleasure to be back here. Thank you for putting this very nice series of seminars together. Thanks very much, Baeey, for agreeing to do that. And without further ado, let's move to our topics. So basically, as Juliano said, I decided to change a little bit and do what I learned from Baeey from the Bellagio group, to which he invited me many years ago, and I'm very grateful for that. It's a lot of fun. Basically, we have topics, then people discuss. But here, I'll talk very briefly about each topic, 1 minute max, and then I'll let Baeey talk for as much as he wants about each one of those topics. So let's move to that. So I heard from Baeey himself in a live with Ricardo Reis that there can be no live of Baeey Eichengreen talking about the current crisis without the comparison with the Great Depression and the 2008 Great Financial Crisis. So Baeey, could you start by telling us the main points about such comparison?
The main point about such comparisons is to treat them very carefully, because I think this crisis is fundamentally different from financial crises past, and in the most part, fundamentally different from other economic crises past. So we haven't really seen a crisis where we chose to shut down the economy like we did this time. In other cases, economic activity has been disrupted by problems in the financial system or elsewhere in the economy, but this time we really chose to shut down the supply side, and that's the opposite of what happened in the global financial crisis or the Great Depression, where demand collapsed. Eventually, something that had implications for the supply side as well. People like to compare this crisis with the 1918-1919 Spanish flu pandemic, which was global, to be sure, but I think also was very, very different from what we're going through now. So that pandemic started in the midst of World War I, where governments had already ramped up public spending and were on the verge of ramping it back down. That pandemic occurred in a much less urban industrial world than today. So it spread in urban centers, like this pandemic is spreading in urban centers, but economies were less urban than they are now. Its incidence was different in terms of hitting young people the hardest rather than older people the hardest. So I think all of these comparisons are highly imperfect, highly incomplete, potentially misleading. I think you can look at some earlier episodes to shed light on specific aspects of what we're going through now, or we're about to go through now. For example, if you're interested in what we're going to do with all this debt that we're accumulating as a result of crisis response, or if you're interested in what the implications of close cooperation between central banks and fiscal authorities will be in the longer term, then you can look, for example, to the aftermath of World War II, where advanced countries came out of the war with even heavier debt loads than they have now. And when central banks had basically given up their independence in order to take instructions from fiscal authorities about the level at which they were supposed to peg interest rates. So you can ask, what were the consequences of that for inflation, for debt reduction, etc.? But there is no template on the basis of past crises that we can look to in order to predict how this crisis is going to play out. I've always been queasy, uncomfortable about the way policymakers use past crises to guide their thinking about how to respond to the current crisis. I wrote a book about that. In fact, Hall of Mirrors came out in 2015, which compared the Great Depression with 2008 global financial crisis, and pointed out how lessons of the Depression both informed and distorted policymakers' views of how to respond to the global financial crisis. So this time, I think there have been some constructive lessons drawn from the experience of 2008. Central banks have responded quicker, more forcefully, where in 2008 there was something of a delayed response. Fiscal authorities have responded this time more forcefully and more quickly because they discovered that fiscal stimulus taken in depressed economic conditions doesn't immediately augur high inflation and currency depreciation. Maybe we can come back to currency depreciation in the Brazilian case, but more broadly, it doesn't guarantee the currency will collapse. So there have been some useful lessons, but I think we're very much in uncharted terrain where historical analogies only go so far.
All right, so let's keep on the issue of comparison with the Great Depression, and let's talk a little more about globalization and trade. And for that, I want to use a chart that you must be familiar with, but I was presented to it by my colleague Marcelo Abreu, and I've been using it in my macro class. And that basically shows how world trade contracted during the Great Depression by about 2/3, right? And I think we learned the lesson in 2008 that did not happen. The current pandemic got us in the middle of a trade war, and we're going to talk more about that. But we've been hearing a lot about now it's the time for the just in case in lieu of the just in time. And here in Brazil, as you might know, we like a lot we don't like trade a lot, right? During the right-wing dictatorship, industrial policy was done by looking at the input-output matrix, looking where the imports were and saying, look, we're going to produce that here. But during the Workers' Party, they had the policy of national champions. So basically, we like a lot to do these kinds of industrial policies. And I think that may become a worldwide trend. So what can you tell us about that?
Marcio, can you put that diagram back up for a moment? The spiderweb diagram. It's important to observe a couple of things about this. Number one, a lot of the contraction of trade reflected the collapse of price levels, and not only the decline in the volume of trade. Number two, it was mainly declining demand as opposed to declining incomes, as opposed to protectionist measures that fed this downward spiral. So everything combined in a way to deflation and collapse of incomes and protectionism to produce this outcome. So maybe we can avoid the deflation this time. Maybe with monetary and fiscal stimulus, we can limit the collapse of incomes. And that leaves us with protectionism, right? both protectionist policies of governments and reshoring commercial protectionism, if you will, by companies that have discovered that not holding inventories can get you into trouble, relying on parts and components imported from countries that are on lockdown can get you into trouble. Maybe just in case is a better way to go than just in time. So I do agree that we will see some reshoring of production and some shortening and diversification of global supply chains. That will make for slower growth of potential output because firms will be investing in insurance as well as in maximizing the efficiency of production today. And there will be some trade-offs between the two. I'm more worried about the fact that this pandemic and the economic nationalism that it's giving rise to occurs against the backdrop of protectionism and economic nationalism, which had already been on the rise. Trump had already been engaged in a trade war with China. Trump had already been renegotiating in slightly more protectionist ways the North America Free Trade Agreement. Trump had already slapped tariffs on cheese and wine imported from France. I especially regret that last aspect. So this provides more impetus, if you will, for those instincts. Now it is said in the United States we shouldn't be importing from China, both because they play unfair, but also because we can't trust them that their exports to us will be safe. So there is that danger. And I'm sure many of the same instincts are at play in Brazil and elsewhere. The problem is that we have international organizations like the World Trade Organization that are designed to limit recourse to such policies and to provide a venue where governments can provide one another with reassurance about the fairness and the safety of their trading practices. And a certain country and a certain national leader had been challenging and undermining the effectiveness of those organizations by not allowing the appointment of the arbitral panel of the WTO, preventing it from adjudicating cases. So the backdrop is what makes the current situation, I think, so troubling. What can be done about it? In the United States, there's a longstanding debate about whether the Congress will stand up to the president, the Republican Party, traditionally being for the last 50 years, being the party of free trade in the United States. Well, the Congress has not had the backbone to stand up to the president so far. There's the question of whether there is a different president in the US starting in January. His trade policies will be fundamentally different from Trump's. And I think the answer there is yes and no. Yes, they will be less arbitrary trade policies. They will not be based on the view that trade is a zero-sum game, which is the current Trump administration view. But Cold War 2.0, the tension between the US and China will not go away. And I think the freedom of trade between the US and China that we saw before 2017 is unlikely to return. A final point would be that we've heard predictions about deglobalization before. When we had the attack on the Twin Towers in 2001, 9/11, there were lots of statements to the effect trade is unsafe, allowing people to move freely through airports is unsafe in the United States. We set up the TSA. we learned how to X-ray shipping containers, and the pace of globalization slowed a bit, but it didn't run in reverse. And it's possible that what we will see now is again the same.
So we hope that the demise of globalization has been greatly exaggerated, right? So now let's move more into international finance and talk a little bit about the action of the Federal Reserve and other central banks. So not only the Federal Reserve has put the interest rate at the zero level, but also added more than $3 trillion to its assets, and probably there will be more 1 trillion to go. Can you tell us about the effectiveness of such measures, and thinking a little more about what's going to come afterwards? Talk more about what you already mentioned about what will be the consequences for central bank independence.
To start with the effectiveness of the Fed's policies, we have to define effectiveness, or ask the effect of the Fed's policies on what? The Fed's objective was not to prevent a recession because we shut down the economy and the recession was baked in. Rather, the Fed's objective was to prevent chaos in financial markets and to bring spreads back down where they had shot up, to bring yields on municipal bonds back down to the neighborhood where they had been before the crisis. And there, the Fed's policies have been highly effective. Some of them, like the municipal bond program, only had to be announced, not actually activated in order for the effects to be felt. Now the Fed is beginning to do more. It's expanding that municipal bond purchase program. Another indication of the effectiveness of these policies is that financial capital is beginning to flow back into emerging markets where it had flowed out. In the last week, it's flowed back into Brazil on net, right? Who would have thunk, as we say in English. So the Fed has been very successful at bringing yields on safe assets way back down to where they were before, and many risk assets way back down, such that investors in the United States are looking for other places where yields are a bit higher, and lo and behold, they are finding them in Brazil even. So from the point of view of what the Fed wanted to achieve, I think it has succeeded. Its message throughout has been, if you want to minimize the severity of the recession, that's a responsibility of the fiscal authorities. Jerome Powell his mantra has become, this is a problem for the fiscal authorities. We, the Fed, are doing what we can, but in terms of getting the economy growing again, that's a problem, not a problem that we can solve. That's a problem the fiscal authorities need to address. With what implications for the central bank? You have to start by asking, what is inflation going to do as a result of the monetary and fiscal actions being taken in response to the crisis? The markets think there will be no inflation in the United States. If you look at surveys or you look at swap rates in bond markets, they see the Fed undershooting its inflation target of 2% for the next 10 years. Should pause and let that fact sink in. So why do we care about central bank independence? We care because we fear a loss of independence will jeopardize the central bank's ability to meet its stated commitments to carry out its mandate. And if its mandate is 2% inflation, nobody seems to be worried about that for the moment.
Okay, so now let's suppose that we finally are over with the pandemics, and we have some sort of a way to live with the virus, be it a vaccine or a treatment, we'll be left with lots of debt, as you already mentioned, okay? And that will be true in the advanced countries, will be true in the emerging markets, okay? And the problem is how to deal with it. You mentioned already financial repression was a way to do it. After World War II, the US embarked in that for a few years until the Fed Treasury Accord. And again, it's hard to think, at least for me, that you could do it with the current financial markets that we have without destroying them. What's your view on it?
Let's start by defining what we mean by financial repression. Mm-hmm. So some people look to earlier historical episodes where there were controls on the ability of people to invest abroad and limits on the operation of different financial markets. I don't think we can go back there. I think financial globalization and financial sophistication have gone too far, but there's a different definition of financial repression, which is the central bank does whatever it has to do to keep interest rates down at 0.5%, which is where they are now on 10-year treasury equivalents in a bunch of countries. And if you think the markets are right and that there will be no inflation for the next 10 years because private spending will remain weak, precautionary saving is now going to be higher in the US and many countries where households discovered in the pandemic that they didn't have an adequate financial buffer, then you can get this softer form of financial repression, namely central bank yield curve control that keeps long-term interest rates down at or below 1%. And then the growth rate of the economy can be higher than the interest rate on the debt. And your debt dynamics are going to be more favorable. The other element of that is, of course, the growth rate has to be positive. It has to be above the interest rate. And in a low to no inflation environment, that means real GDP growth. So we've got to achieve that as well. And there, I would observe that in principle, countries like Brazil are in a better position than the US. Your demographics are still more, they're turning, but they're still more favorable than ours. That's another important difference from the post-World War II period, that with slower potential GDP growth, it's harder to have a favorable growth rate, interest rate differential. And the third element, which we also pursued in the US and other countries after World War II, was balanced budgets or primary budget surpluses. And that certainly helps to work down heavy debts as well. So in my view, the only country cases where heavy debts have been stabilized and brought down, where debt overhangs have been successfully consolidated, are where countries have implemented all three strategies or put in place all three ingredients: primary budget surpluses, successful economic growth, and the maintenance of low interest rates. For the US, I'm only confident on the third of the three, the maintenance of low interest rates, because I think inflation will be very low, but I'm worried about our ability to grow, and I'm worried about our political commitment to run primary budget surpluses for a decade or two. I did an earlier study with Ugo Panizza on large primary surpluses because we were concerned that the European Commission was demanding of Greece and other countries that came out of the global financial crisis with heavy debts, that they should run very large primary surpluses for 10 or 20 years. And we could find only three cases in modern history, Ireland and the Netherlands in the 1980s and Belgium in the 1990s, where countries had actually succeeded in doing that for 10 or 20 years. Will the US be able to do it? Large primary surpluses are especially hard to maintain over long periods in politically polarized societies where the party of the left wants to spend on its favorite programs before it loses power to the party of the right, and vice versa. I think you know this history in Brazil as well.
Yeah, except that we have more than 30 parties. That adds to the confusion. But just keeping on that item, that issue, so that pessimism that you just mentioned, do you think this may threaten the exorbitant privilege?
The reason that the dollar is and can be used so widely internationally, the reason why central banks around the world are able to hold 60% of their foreign reserves in the form of dollars is that the US provides a lot of dollars. It pumps out a lot of treasury bonds and bills that are on the balance sheets now of central banks around the world. But we know that's a delicate balance, that there have to be enough to satisfy foreign demands, but there comes a point where foreign central banks and governments may come to doubt the ability of the US government to redeem those bonds. The fear is that the United States will inflate away their value. And again, I think people are confident that this will not be a problem for the next 10 years. Again, that's what swap rates and financial markets and other indicators suggest. I would argue that there are other more immediate threats to the international dominance of the dollar. The fact that the Trump administration is weaponizing the dollar and threatening foreign governments that do business with Iran with loss of access to US banks and loss of access to US financial markets. I worry that people like Senator Lindsey Graham, a very senior member of the US Senate, suggested that, and here I'm paraphrasing what he said, because China had exported the virus to us, we should suspend interest payments on the treasury bonds that the PBOC held. What do you think that would do to the confidence of reserve managers in other countries? So, the dollar is used internationally so widely and held so widely by foreign central banks because the United States is viewed as a responsible country, and that view has come under challenge.
Yeah, so now it's time then to pursue what you said about the trade war and move to what I call the clash of the titans. So what are the perspectives for the US-China relationship? And you mentioned that will a lot depend on the US presidential elections. So we also would like to hear a little bit about what is your forecasts for the presidential elections in the US.
I don't have a forecast other than to say it will be much, much closer than the polls currently suggest. You will have noticed that Biden seems to have opened up a very large advantage over Trump in the latest polls. And we can be sure that will shrink, and we can be sure that everybody will stay up late at night on the first Tuesday in November when the election happens. I resist providing predictions here because I don't know whether I'm going to be speaking from the head or the heart, and they often lead to different views. As I said before, said part of this before, any future administration will be less hostile toward China and more constructively engaged with China than the current administration. No future administration will have an economist like Peter Navarro, the author of a book called Death by China, on its senior staff, giving it advice about things like trade policy. At the same time, it's clear that views not only in the US, but more broadly in Europe and elsewhere toward China have changed. And the idea that by engaging with China economically in terms of trade, otherwise we can move the country gradually in the direction of democracy and openness. People don't believe that anymore. So I think there will continue to be tension between the US and China. Problems like the 5G problem and Huawei will continue to recur. And all of that, I think, will be ongoing tension within globalization.
Okay, so we have time. I was fearing that we didn't have time. So let's talk about Europe, the old continent. And so it's a continent that has been suffering lots of stress, at least since the crisis. But now it had the renewed stress of the pandemics. And it happened when Brexit had just happened. So what are your thoughts about the future of the euro and the European Union after the pandemics and the Brexit?
Well, I think what we've learned is that Brexit has been a good thing for the euro and the European Union. Nobody wants to go through what the United Kingdom is putting itself through and trying to negotiate a trade agreement with the EU and avoid 20-kilometer-long queues at Dover as they try to import and export. The European Union has responded to the pandemic with a proposal that is likely to be elaborated further and implemented in coming weeks for a common European Union bond issuance of 750 billion euros that will transfer as much as 15% of gross national product to the hardest hit countries. So that's a big transfer from the countries that are doing better to the countries that are doing worse. That wouldn't probably not have been possible, I think, had the United Kingdom, which has always opposed further expansions in the European Union beyond the single market or the free trade area, had the UK still been part of the negotiation. So from that point of view, the European Union has taken an important step forward in the direction of strengthening its own institutions, strengthening its collective identity, and helping the countries that need help the most in its pandemic response. Will it be enough? There, we don't know. So Italy had already been in terrible shape. Italy is now basically back in terms of per capita GDP to where it was in 1999 when the euro was adopted. Pause and ponder that. That's a pretty, the result of a long period of stagnation and now a very deep recession. So will 15% of GDP spread over 4 years be enough to compensate for that, enable Italy to consolidate its debt, live happily within the euro area? We don't know. These are challenging times for everybody, but I think it's impressive how the European Union has responded. People sometimes refer to this as Europe's Hamiltonian moment. They're referring to Alexander Hamilton. You will have heard of him from the musical. US Treasury Secretary in 1790, who pushed through the agreement for the federal government to take over, to assume the debts of the 13 states incurred in their War of Independence against Britain. There's that same villain. Yet again, could we now see something along similar lines where national debts are mutualized, taken over by the European Union? That we don't know. We don't know whether this 750 billion euros of EU bonds are a one-off, they're a one-time exceptional response to an exceptional crisis, or they're an important step in the direction of fiscal federalism or fiscal union. I think myself, they're a step, but one of many, many more steps that will have to be completed over many more years before Europe gets there.
Okay, so I've exhausted my 6 points. Julian, do we have questions, or I can ask?
Right. Yeah, I think you can. Well, let me ask a question myself, and people that is interested in making questions, please raise your hands, and then we will start to open up the mic so we can do it by yourselves. Let me ask a question about the nature of these risks that it seems that we figure out exist, right? And I think the pandemic showed that there is this kind of risk that affect the supply side, and from the supply side also has some implication for the demand side in such a way that change things dramatically. And if you believe that this is a risk that probably will continue to exist, not only through this particular virus, but probably through other viruses that can, or other epidemic that can outbreak, what do you think, are the key lessons here in terms of the design of policies, and what have we learned during this process about how to deal with risks of such a different nature, as you mentioned?
I think the experience of the pandemic reinforces some lessons that we had learned from past crises. The importance of having fiscal and financial buffers, that you want to have a relatively strong budget balance in normal times so you can use your fiscal capacity when you need it. You want to have international reserves so you can use them when you need them. You want to have a relatively strong banking and financial system so that it can withstand whatever comes next down the road. So those were all lessons that were learned from Brazil in 1998 and the advanced countries in 2007, 2008, and so forth and so on. But maybe this experience will give us all a little bit more resolve in terms of actually implementing those lessons. Beyond that, I think corporations are going to have to think harder about building in buffers at the corporate level. That goes back to the issues about inventories and supply chains and finances. And if you're an airline, not using all your profits to buy back shares, but rather putting some of those revenues in the bank so that you can keep operating when there's another interruption to international travel. If you're a hospital or a public health system, building excess capacity, which has been eliminated in many different places to boost profitability, so that you have the capacity to accommodate a surge if and when a surge comes. It's not always incentive compatible for a publicly traded company to build in lots of excess capacity. So that's where the law, public policy, needs to intercede.
Thank you, Barry. Vitor, your mic is open.
Thank you very much, Juliano. Can everybody hear me?
Yeah.
Yes.
Oh, and thank you so much. Thank you, Marcio. Thank you, Barry. Good seeing you guys. I was just wondering if you could go back a little bit to point 5, the Clash of Titans, and if you guys could comment on whether this new U.S.-China conflict can be seen as a new Cold War and perhaps similarities with the former conflict, and what that could mean for the U.S. global position as the #1 powerhouse today. Also, if you could talk about how the renminbi might challenge the dollar and the U.S. exorbitant privilege on the Eastern front, especially Asia, and perhaps make the dollar the currency of the West in this new second Cold War scenario.
Cold War 2.0 is a fashionable term or label to use, and it's a bit misleading. The Cold War was really a situation where the world was divided into 2 zones, and they did very little business with one another. There were exceptions now and again. So money center banks in New York and London lent lots of recycled petrodollars to Eastern Europe in the 1970s, but those exceptions were rare. Now the US and China are very interdependent economically and financially. So this is a different kind of struggle where there are conflicting interests, but there also are interests in common in trade and finance, and I think, and climate change and other areas. So I think we have to think about this differently, and it will be important in order to have stable financial markets, in order to have a world trading system that continues to operate as we have come to expect, to deal with the climate change issue, for the countries to figure out a modality, a way of working together with one another. And it's not clear that the present set of Chinese and US leaders think about the things that way or are capable of doing that. On the renminbi, I'm kind of 2 minds. I think it is a very peculiar equilibrium to be in, where China is the single most important trading nation, and its currency is hardly used internationally at all. Rather, the dollar is. So the renminbi accounts for less than 2% of payments through SWIFT, where China accounts for a massively larger share of global trade. You would expect it, therefore, to be able to encourage the countries that it does trade with, that it does business with, to utilize its currency, because that would be convenient for Chinese banks and firms, and maybe not too inconvenient for other countries that trade with it. At the same time, I think there are concerns on the part of those trading partners. So let me give you an example I heard about recently. Merchants in Seoul, South Korea were asked, are you comfortable using Alipay, which is the big electronic platform in China, when doing business with Chinese customers? And they said, sure, we're increasingly using Alipay. So the next question was, would you consider using a digital renminbi if the People's Bank of China issued a central bank digital currency? Would you use that as well? And a lot of respondents answered, we'd kind of be worried about a backdoor, a surveillance technology, that they were building in an ID to track the transactions of people using their currency. Maybe we would prefer not to use that. So I think there is an issue about the Chinese system and whether, and about currency internationalization. When I go to China and I'm asked about this, I like to answer, just to make my hosts a little bit uncomfortable. Every leading international currency in history has been the currency of a political democracy or republic. So how far might China have to move down that road before people felt comfortable about using the renminbi?
Thank you, Barry. Mario, your mic, I think it's...
Oh, thank you very much. Professor Eichengreen, Professor Marcio Garcia, it's a very good pleasure. I live here in the Amazon region, and thanks to the internet network, I can talk to you. As you've seen in the kind and the crisis we live in, the balance sheet of central banks as a unconventional monetary policy has been in the USA and Eurozone and Japan, it has a history already. But here in Brazil, the Congress has not authorized, has not allowed the central bank to use the quantitative aids in the primary markets. So differently from the United States Federal Reserve Bank, it can buy and sell in the primary markets, it can buy and sell in secondary markets, but here in Brazil, we're not allowed to do that. What would you think about that? Are you using bullets or short of bullets here? Could use more the central bank force?
I'll make a general comment and then I'll pass to Marcio to talk about Brazil because he knows much more. I think one of the positives, one of the silver linings of this COVID-19 crisis is that central banks in a number of emerging markets have been able to do QE. Traditionally, they haven't been able to do that because there's so much foreign currency denominated debt, and QE means currency depreciation, and that causes big financial problems. The fact that some central banks have been able to support their economies when hit by the pandemic by doing QE is an indication that progress has been made on this foreign currency debt problem and on the central bank credibility problem.
Yeah, from what I heard, I was also intrigued, so that Baeey knows. The central bank was forbidden by the Constitution to buy treasury securities to finance the treasury. It could buy securities to do monetary policy, but not to finance the treasury. So now it can, and it can also buy private securities, but only in secondary markets, okay? So I tried to ask people about it, and I've heard two different answers. One was that there would be many obstacles, legal obstacles, but since that change required a constitutional amendment, I didn't quite understand what was going on there. And the other was that in order to buy at primary auctions, or at the primary market, not primary auction, but primary market, there would be an issue of fair pricing because these would be very illiquid markets, and then the central bank would be in trouble to do that. By the way, many government officials say that there are a lot of fear inside the central bank of actually doing any kind of purchase of private securities, exactly because of this insecurity that later on in your life you can be sued or you can even go to jail because of that. So that is a problem. So let me just jump into this debate and ask you about another issue. Yesterday, the Brazilian Central Bank lowered the Selic rate, the basic rate, to 2.25, okay? But even doing that, the forecasts of inflation are much lower than the inflation target. So if it were only an issue of achieving the target, the central bank should have lowered the rate much more. But the central bank alleged that there is another issue, and the issue, actually there are two, but the important one would be the risk premia that could arise because the fiscal situation in Brazil is deteriorating a lot. We are not only, we are doing the large expenses for the, to fight the pandemics, but also there is a fear that those expenditures could become permanent, and then we would have a major worsening of the fiscal accounts, and the debt would become unsustainable. So the issue is, but at the same time, there are many emerging markets like Chile, the Czech Republic, Poland, Thailand, that they are with a rate near zero. So what do you think about this issue about regarding achieving the zero lower bound at the emerging markets and the fear, of course, of capital flight?
So as I said before, it is striking how many more emerging markets have been able to cut interest rates in response to this crisis and downturn than had been true in the past. Some people in Brazil might be critical of the central bank for not doing more, but it's quite astounding for someone like me who doesn't follow Brazil every single day to be reminded how low the Selic has fallen and how inflation is not a problem in Brazil after all these years. So Brazil is among the countries where the central bank has been able to respond in the direction that supports the economy, rather than moving the other way, which it has had to do sometimes in response to previous crises where the capital flight problem was even greater. Why is Brazil different from Chile or the Czech Republic or wherever? There's a visible reason and a less visible reason, or a economic reason and a political reason. The economic reason is that the exchange rate has kind of fallen through the floor, right? If the central bank were to let it rip and the exchange rate fell even more dramatically, that would have two consequences, right? It might create even bigger problems for corporates with dollar-denominated debt, and it would give rise to expectations of more of the same, panic selling and all that. So I think there is probably some caution there about going one step at a time and seeing how the foreign exchange markets react. But Brazil is also different from Chile or the Czech Republic. Everybody has contentious politics, divisive politics, political disagreements, demonstrations in the street today. Chile has them, but you have even more of them, right? So central bank has more room for maneuver against stable, placid political backdrop than it does against the backdrop of polarized politics.
Thanks, Barry. Let's take, as we are approaching the end of our time here, let's take a couple of questions. But before going there, I got a question here, which is about the recovery. Do you think, do you have an idea or any guess about how this recovery will take place? Which letter, if any letter? And then we'll collect the questions by Carlos and Sidney. Carlos, I think you're allowed to talk.
Standard disclaimer would be you should ask an epidemiologist rather than an economist. It all depends on the virus. But given what we see now in the US and Brazil, it's not promising. It looks like a W or a series of Ws until we really get the virus under control. I've never been a believer in a V-shaped recovery. It is true that retail sales rose by 18% in the US last month, but that forgets that they fell by 36% the month before. And now some states that had opened up restaurants and so forth are closing them back down as the new cases of COVID begin to rise more quickly. It depends, the shape depends first and foremost on public health policy, but I think there are a variety of reasons why even under good public health policy, recovery will be slow, that workers have been displaced, restaurants and firms are going to go bankrupt, resources are going to have to be reallocated gradually over time, and all of that will slow growth.
Thanks. So let's take two questions now. Carlos, your mic is open.
Okay, thank you, Juliano, Marcio, and Professor Baeey. I'm Carlos Mussi from CEPAL, United Nations. My question, you just mentioned that how industries and services have to change their operations in the future, considering what's happening. If we think there is still the risk of a climate crisis, do you think also consumers will change their patterns? Should we expect that knowledge should flatten the curve in the epidemics, but also flatten the curve in terms of the emissions, like the Economist recently put it out?
One thing everybody...
Let's take another one, Barry, sorry.
Okay.
Because we're in the end. Sydney?
Marcio and Juliana, congratulations for the initiative. This is Sydney Nakahoro, Columbia University. A question for Professor Eichengreen is that, Professor, you mentioned two different movements related to the rise of nationalism and also strengthening of the importance, so to say, of the European Union vis-a-vis supporting some member states. Can we talk about the net effect on multilateralism, given the...
Okay. I think the question of whether we will have a multilateral moment and countries will recommit to international institutions or not. In Europe, I do think there has been a recognition that if the European Union doesn't respond collectively to this crisis, people will justifiably ask, what is the EU for? Whether we will see the same kind of thing on a global scale, I don't think we can say. I do believe that the argument for a multilateral response led by the IMF and the World Trade Organization and the World Health Organization is sound. I'm less confident that we will get it. On the so the earlier question was about the connection between the crisis and other challenges like climate change. One thing that everybody says, and despite the fact that everybody says it, it can also be right, is that the pandemic has accelerated trends that were already underway. And we see that in a variety of domains like online shopping and telehealth and so forth and so on. I think the crisis will accelerate investments in climate change abatement in places where those investments were already being made. So part of the European recovery program is more investment in climate change abatement at the same time. Will the same be true of the US and China? Neither the US or China had been making rapid progress on climate change abatement. Trump had been rolling back steps that had been taken. China had been firing up new coal-powered plants. So here too, the response is likely to be different in different places, different regions, and different countries will respond differently, I think.
Thanks, Barry. Sydney, sorry, I think I cut your mic accidentally. So if you want to continue your question or was finished. Okay. All right. So it's 7 o'clock. So I'd like to to thank Professor Eichengreen so much for this brilliant discussion and Marcio for organizing this event. I think it was great to have all of you in our closing session. It's been a real pleasure to organize this webinar series, and I'd like to thank the audience to be so interested in joining us for all of these 10 sessions that we had so far. So I think we'll stop here. Thank you guys so much.
Thank you, Baeey. And it's too bad that we meet in those circumstances where our two countries are winning this inverse championship of the pandemic. So we hope we do better in the future.
This is not the World Cup of pandemic.
Right. Thank you guys so much. Take care. Cheers.
Thank
Bye-bye.
you. Thank you.
Thank you.